Next in line of our momentum indicator series is RSI. RSI was developed by Willis Wilder, and it is also one of the most widely used technical analysis indicator. RSI is a momentum indicator that measures the speed and change of a price move. RSI tends to oscillate between 0 and 100. A security price is considered overbought when RSI reaches above 70. Similarly, a security is considered oversold if RSI reaches a region of 30 or below. RSI can be used or interpreted in variety of different ways. Some of the most important ways to interpret RSI are: 1. To find securities in the overbought and oversold regions. To find divergence in price tops or bottoms. 3. RSI can be traded for failure swings. And 4. Positive and negative reversal setups. Let's go ahead and learn about each one of them. Overbought and oversold regions or conditions in RSI. One of the best and simple use of RSI proposed by Willis Wilder is identifying overbought and oversold securities. Just like any oscillator, overbought and oversold tends to work well in non-trending market. In trending markets, a stock may be in overbought and oversold region for longer period of time than anticipated. Let's take a look at an example. Following is a daily chart of Acacia. It's a script traded on NSE exchange. In the upper part, price chart is plotted, and in the lower part, you can see RSI. You can see RSI looks like a bit more zigzag than stochastic oscillator. It looks much more zigzagger than stochastic oscillator because stochastic was smoothed over a period of time. But RSI tends to plot prices and hardly uses any smoothing factor. But in the first look, you can see RSI tends to depict tops and bottoms much more accurately as compared to stochastic. The green colored circles suggest levels where RSI reached above the 70 line, and you can see every time RSI reaches the level of 70, prices tends to change that direction. Even here, though prices change direction for a limited period, but a correction did come. Here you can see prices reaches an oversold condition, prices tend to change the direction. Stochastic reaches the level of 70, gives a reading of above 70, and prices find the short-term top. React come down, and stochastic gives a reading of below 30, prices change their direction and surge higher. Here again stochastic gives a reading of above 70, which is followed by a sharp correction in price, but then trend resumes and prices go on to make higher highs, and stochastic tends to linger in above 50 region. So even though stochastic tends to find tops and bottoms better than any other oscillator, RSI tends to find tops and bottoms better than stochastic, but in a strong trending market, RSI might linger in overbought zone and the level of 50 for longer period of time before the prices truly reverse. Let's look at an example. Following is a chart of A Birla Novo daily chart, and you can see in this region stochastic gave a reading of below 30. Prices continued to trade sideways and then rose above, and here stochastic gave a reading of above 70, indicating that A Birla Novo is now in overbought condition or in overbought zone. From here, prices make higher high, stochastic fails to make go any further, but then prices correct and consolidate for over a month. Stochastic reaches level of below 50, finds support. You can see stochastic is time and again finding support of 50 level, and prices starts to surge higher, or prices start to make higher bottoms. And you can know, and you must know, that higher bottoms is characteristics of an upward trending market, and stochastic tends to find support at level of 50 time and again. You can see every time stochastic reaches level of 50, prices tends to find support and change their direction and surge higher. So this is characteristics of an uptrending market. In an uptrending market, stochastic never reaches its level of 30, or stochastic never gives a reading of below 30. Rather, it tends to find support in the region of 50 and 40. Similar and exact opposite is characteristics of a downtrending market. Let's go ahead and take a look at a chart of downtrending market. Following is a chart of Supreme Infra traded on NSE exchange. You can see the stock is in a downtrend as it is making lower tops and lower bottoms. This lower top and lower bottom is supported by RSI. As you can see, RSI reaches level of 30, pulls back but finds resistance at level of 50, and then trades down to the level of 30, pulls up again, fails to go any above, fails to give a reading of above 70, turns around and gives a reading of below 30, suggesting the fact that RSI is time and again finding resistance at 50, and prices continue to trade lower. So this is one of the characteristics of RSI through which you can find downtrending market or an uptrending market. In an uptrending market, RSI tends to oscillate between the level of 70 and 50. Similarly, in a downtrending market, RSI tends to oscillate between the level of 30 and 50. In a downtrending market, it's rare that RSI will trade above 70. And in an uptrending market, it's rare that RSI will trade below the level of 30 unless there is a change in direction of price. Next best use of RSI is in finding divergence. Divergence is when prices and RSI does not make similar patterns. Sometimes RSI will make new highs, but prices fail to break through previous highs. Whereas sometimes prices make new highs, but RSI fails to make new highs. There are bullish as well as bearish divergence to help identify a possible top and bottom. Let's go ahead and take a look at few examples. This is the chart of Sun TV traded on NSE exchange, depicting bearish divergence, which is when prices makes new highs but RSI fails to make new high. You can see here prices have went ahead. In fact, prices have almost made a double top. Rather than going higher, trading higher, prices have made double top. But RSI has made a lower top, thus giving a divergence. where prices and RSI do not agree or disagree, telling us that the recent top is questionable. Validity of recent top is questionable, and you can see prices change their direction and start trading lower. Next is a daily chart of 7. In this chart, you can see there are two divergences. First one is a bullish divergence where prices make higher bottom but RSI make lower bottom. Thus prices and RSI disagree. Prices change their direction and goes ahead to trade at higher levels. Comes a a bullish divergence where prices make higher bottoms but RSI goes ahead to make lower bottoms. Bullish divergence forms when security makes new low but RSI fails to make new low.